everyone. My name's Anthony Kapitanovich, and thank you for joining us once again for this latest edition of the Akambo Investment Series. Chris, a few months ago we sat here and we spoke about another stellar year for the share markets generally. It's been a bit bumpy since then. What's happened?
Yeah, well, up until the 3rd of September, our share market had been travelling quite well. We're up probably about 6%. For the year. We had Commonwealth Bank up near record highs, BHP up at its highest level in nearly 3 years, and Telstra up at its highest level since 2001. So the heavyweights were performing quite well. Most of the major banks were being supported quite well on the basis of their dividend yields being quite strong. We've had a few things happen since then. One of the more notable things for the Australian share market that we noticed from early September is that a lot of the international money that had been coming into Australia for the past few years on the basis that it was seeking some low-risk investments with high dividend yields or high income, and that equated to the Australian banks, to Telstra and to a number of other industrial stocks in Australia that pay good dividends. International investors were lured by those high income payments when the Federal Reserve Bank of America, the central bank, gave a whiff that they were going to start putting interest rates up in America. That had a pretty big impact on the allure of Australia as a destination for high-income investors. So what we saw is that a lot of these foreign investors have pulled a lot of their money out of Australia with a view to invest in US Treasuries. And the view has also been that as US interest rates increase over the next 12 to 24 months, we're going to see the US dollar increase, which obviously means the Australian dollar is going to be decreasing, and therefore foreign investors don't want to hold as many Australian assets because the falling dollar is going to undermine the yield that they'll be getting from these Australian assets. That was one of the more notable features. Since then, there's been a few other things transpire. There's been more concern about the US economy and the rate of interest rate increases, and also a lot more concern about how the European economy is tracking too.
The US market has generally fared a bit better than ours in the past, but even that's starting to show some signs of increased volatility, and the bumpiness is coming into that. How much is the US market being driven by that prospect of increased interest rates in the US?
Well, most of the talk over the past month or two has been that the volatility that we've seen come back into share markets is related mostly to the prospect of interest rates going up in the US. Now, the central bank over there has indicated that that's not going to happen for another year. We're talking about late 2015. What's, I guess, concerned the market more in the last couple of weeks is the fact that there's been more signs coming out of Europe that their economy is really struggling, that deflation, not inflation, but deflation is a real threat over there. And even more recently, there's even more fears that the German economy, which has been the engine room or the saving grace for the European economy for the past however many years, was starting to struggle as well, and fears that Germany might be moving into a recession. So that's nothing new. Europe's been struggling for several years, so that's no surprise. But I guess the fact that that's happening at a time when interest rates are being talked about going up in the US, it seems quite possible they'll be going up in the UK at some point in the next few months, and the fact that we've seen some still weak signs out of China, some fears over the Chinese property market, fears of excessive debt levels in China, and there's a real confluence of these negative features, I guess, and all that's really compounded to the point where we've seen markets have some sharp falls, in the first part of October.
In terms of property in Australia, obviously it's not going to be news to anyone that Australian property has been very strong over the last few years, and obviously driven by low interest rates, the ability to borrow money at low interest costs. You mentioned interest rates going up around the world. How do you think property was likely to fare, as this plays out?
It's a really interesting scenario that we find ourselves in here. We've seen US property prices, in fact property prices around the UK, the US, Australia, very strong over the last few years, to the point where we've seen the UK and the US talk about putting up interest rates. In Australia, some parts of the economy are still quite weak. I couldn't see the Reserve Bank putting up interest rates within a year. I think it's likely that we'll have interest rates at these levels for at least a year, possibly two. So you would think that with low interest rates, there is going to be every possibility that we see continued demand for property as an investment. The disturbing feature of property at the moment is that most of the new loans that we see taken out for property have been from investors rather than those who are going to dwell in the properties they buy. So that starts to have a whiff of speculation about it. And of course, investors are lured to property by obviously the prospect of growth, but also by certain tax incentives to invest in property. So what we've seen in the last month or so is more talk of there being the buzzword seems to be macro-prudential regulations around how much banks can lend, how much people can borrow. So that's just, I think, stirred up some fears that the share price growth in banks might start to slow, and also some fears that the growth we've seen in residential property prices and commercial property prices, that might have seen its zenith in the last year or two. And of course we get to the point now where we've seen a lot of Chinese investors buying residential property in Australia too. So there's a bit of an arm wrestle between the Chinese buying and the fears that we might have seen a top in Australian property prices.
Chris, thanks for the good summary of the past quarter, I suppose. How do you see the next few months panning out, more importantly?
Well, as I said, we've had some reasonable falls in the share market. I think that's quite healthy. There'd been talk of there being some bubbles forming in world share markets, some frothiness in some share prices. I think the fact that we've seen a lot of share markets pull back, that's been quite a healthy thing. We see now that the dividend yields on Australian banks are now over 6%. Add on franking credits and you're getting a pretty decent return over the next 12 months. So I think we're seeing a lot of shares back at decent levels. Interest rates are still low, and I think that will entice people to deploy cash and other idle assets into share markets and assets that are going to generate growth and income. So for that reason, I think you'll see some support in the share market around these levels, and I'm quite confident about the next few months on the share market giving some reasonable returns. That said, next year we're going to be confronted with the headwinds that we've been talking about. A rising interest rate environment in the US, fears of a slowdown in China, an Australian economy that's just still struggling to get traction post the resources boom. So they're, I think, going to be next year's issues for the share market. But given that we've had recent falls, I think things are looking reasonable value in the share market at the moment.
Okay, fantastic, Chris. Thanks for your insights once again. I hope you've all enjoyed this latest episode of the Akambo Investment Series. Until next time, thanks for joining us.